If you were to go on an international trip this May, you would be paying 10 rupees more for a dollar than you would pay last year. The rupee is currently at 95 to a dollar, while it was at 85 to a dollar in May 2025. First, the US tariffs in June 2025 and then the US-Iran war in March 2026 has caused the Indian currency to depreciate to near 97 levels. The currency traded at a record low of 96.96 on May 20th. And this has caused many to gauge when the rupee will cross 100 per dollar mark. Naturally, the 100 per dollar mark has become part of every business conversation today. So, we reached out to several economists from India's top financial institutions.
Hi, I'm Gaura. I'm the Chief Economist of IDFC First Bank.
Hi, I'm Kanika Pasricha, Chief Economic Advisor, Union Bank of India.
Hi, I'm Madhavi Arora. I'm the Chief Economist at Emkay Global Financial Service.
Hi, my name is Dhiraj. I am the Economist and FX Strategist at the Australian New Zealand Banking Group based in Mumbai.
In this episode, we ask them where they think the rupee will head. What triggers and deterrents would push or pull the currency towards or away from the 100 per dollar mark? And really, how should one see this fall? In local contexts or from the lens of geopolitics and global trade? Listen on. It's Tuesday, the 2nd of June. I'm your host, Rozebud Gonsalves, and this is the Morning Brief. So we started by asking them, when do they think the rupee will touch 100 per dollar mark?
At least not in FY27, because we expect the government of India and the RBI to come up with some schemes to attract debt capital and to improve the situation. So we don't expect it to breach the 100 rupee mark right now in FY27, but maybe sometime in FY28.
So assuming the current conditions continue, we do not see rupee hitting 100 to the dollar in the near term. In fact, I think if you would have asked me this question last week or last week, where rupee was in a self-fulfilling prophetic mode, maybe, hitting 100 looked like the next best level with the way importers were aggressively hedging for their dollar payments. Now, the current juncture, look at the kind of confidence building both the RBI and the government has done. So the RBI governor over the weekend, the way he spoke about rupee being undervalued. So it's a shift from just talking about defending a level for the currency to actually stating that it's undervalued, which means USD-INR needs to move left rather than right. That's a big change. It's a directional bias to the currency given by the central bank itself. Very positive. And also the finance minister spoke after a very long time, and she completely asserted that while as an economy we stay resilient, it's an open acknowledgement that given the kind of conditions created by the war, be it energy, be it fertilizers or gold, are leading to quick drain of foreign exchange reserves, and to the general appeal to the public as well to preserve it.
A lot would depend on how the global dynamics play out, how the geopolitics play out, and when we actually see the oil market normalize. As of now, we are not looking at rupee breaching 100. We believe that there could be some resolution coming our way, probably mid of summer, which still may keep, Brent a little higher than what one would like in the near term. But I think markets adjust rapidly, so we probably may not see as bad a phase as market is making it out to be at this point in time. But of course, policymakers' stance on the currency also would matter.
Well, only if the current gamut of risks worsens, it could still be about 12 to 18 months away.
Right now, soaring oil prices and foreign investor outflows have been the largest triggers for the rupee's weakness in the past year. But going forward, what could be the events that could finally lead the rupee to cross the 100 per dollar mark?
I think the trigger is definitely the war. The longer the Strait of Hormuz stays closed, the more adverse the situation is. Moment the Strait of Hormuz, let's say, opens up and things begin to normalize, that will be one of the strongest triggers. Either way, either pushing the rupee in the upward direction, downward direction. The deterrent will definitely be some sort of scheme done by the government of India and RBI to attract capital inflows, because this is not a current account problem right now. India, what we are actually facing an issue is our inability to attract capital inflows. So that would be the strongest defense.
I think three big factors. The first is, of course, the Reserve Bank of India's intervention. The second is the state of oil prices. And third, the sentiment of portfolio investors or the foreign investors, simply to put that way. Look, the way oil prices are going, they remain stuck around 100 levels. So if the conflict in the Middle East does not resolve itself over the coming few weeks, the risk is that, it would pull the rupee weaker in the coming weeks and in the coming months. And at the same time, the state of global financial conditions is so tight, the capital constraint is actually rather binding on India right now. And that is where we see risks of a rather long dry spell of capital inflows for India. So those two would be the biggest risk factors that would pull the rupee towards the 100 mark, and offsetting them occasionally, sporadically, and often strongly would be the Reserve Bank of India's intervention, which we have seen has been very, very strong in the last couple of months.
So I would say the trigger to the further fall, as I said, assuming that the current conditions do not continue, so the fragile truce does not actually fructify into a deal finally, and we actually come back to the kind of conditions that was seen a few days back. That's oil price at above $100 per barrel mark. We actually see dollar above $100, the DXY index above the 100 level, a psychological threshold. And these two conditions leading to another round of sharp exodus in FPI outflows. So assuming that there is again a reversal in sentiment, and at that too a very quick reversal in sentiment, which may not be combated quickly by the RBI, given that it's a free fall across the world, including Indian FX, that's the rupee, then we may see rupee moving towards the 100 level. But also want to talk about a positive takeaway. See, we are all waiting for some one short measure from the RBI or the government to get a buffet of dollar flow. I would say at least 30, 40, $50 billion via concessional swap scheme for FCNR, or a more productive ECB related measure, or maybe a bond flow. So some form of debt borrowing done by the RBI or the government that can actually promise quick dollars in a short span of time, that actually would help fructify the turnaround in the currency and may make the USD-INR move further towards the left, rather than the right-wing bias we are questioning and the conditions we are discussing about.
I think with regard to the currency, the strongest trigger would be the fact that despite so much of volatility that we are seeing in energy market, our current account deficit is still comfortable, right? I mean, last year we had printed less than 1% of GDP worth of current account deficit. This year, even assuming Brent averaging, say, close to around 90 or 95, we may still be a tad shy of 2% of GDP. That's a very strong number to look at, despite the fact that oil market is in a very volatile state. The bigger problem for the currency, I think, is in the capital account side, which is where the problem has been lying for the last 1.5 years, and it has only been aggravated in the recent past. The problem with regard to FPI outflows, the problem with regard to sticky flows like net FDI, which has been very patchy or probably negligible in the last 2 years or 3 years. I think they are the bigger problem areas than the current account deficit per se, which is basically weighing on the currency, the sentiment, especially with regard to India versus emerging market, which is leading the FPIs being a little shy on investing in India.
Now, exporters or companies earning in dollars and Indians abroad who send money back are the biggest beneficiaries of the rupee depreciation. But wait, are they really? You see, exporters like a weak rupee. But a sharp depreciation brings in macro stress, like tighter contracts, higher hedging costs, and even expensive logistics. So the next question is, who is impacted the most from this depreciation?
So we are a net importer as an economy. So clearly a rupee depreciation actually tends to hurt us in the near term. Logically speaking, a weaker currency essentially implies that the exporters tend to gain and importers tend to lose, as well as, corporates who are raising money abroad tend to lose. capex cycles tend to also get a hit because large chunk of the input cost is basically denominated in dollar and tends to have a negative impact on the economy. So I think in a broad sense, logically speaking, exporters gain, importers lose. On net, in the near term, the economy loses because we are a net importer. Medium term, of course, a weaker rupee should prop exports, but that is more like a J-curve theory wherein it takes time for exporters to actually grab new markets with a weaker currency, which will play out again in a more medium term basis. And again, it has to be seen in the context of how other currencies are also behaving.
So what we've seen in FY26, when the rupee depreciated by 11%, which is a very strong pace of depreciation, the non-oil exports didn't perform that much because global demand, you had the tariff issues. So we saw a very moderate, muted pickup. So that whole story of you need a rupee weakness for export to grow does not truly hold. What you require is a combination of circumstances. You need a fairly valued currency, plus you need global demand to be in a better shape. And you also need to work on your own, domestic production, cost of production levels to make it more competitive, to be able to, let's say, compete with, let's say, China, which in the manufacturing sector is able to really produce low cost output. So the currency is not that big a determinant of export performance, but we end up paying a very large price when it comes to the capital account, because when you have very sharp periods of depreciation, it deters capital inflows, because when foreign investors view their dollar returns, the sharp pace of depreciation reduces the dollar returns. What ends up happening is we don't get too much of a push for the export, but then the capital account suffers, which is exactly what happened in FY26.
Well, the textbook answer is, of course, exporters will benefit from a weaker rupee, especially the ones that are exporting services or, pharma, things like that. But I'm a little mindful here. A lot of the economies in the world are adjusting to this global shock, especially the tight financial conditions. So it's not a very clean competitiveness gain as far as the weaker exchange rates are concerned. Actually, the real exchange rates for a lot of economies have been dropping below their historical averages. And that really, to me, is a problem in extrapolating rupee weakness into a clear export gain. Now, in terms of the people who lose, I think all of us lose in the sense that commodity prices are very high, oil is very pricey, so a weaker rupee makes it even more expensive for everybody domestically. So to the extent we will see fuel price hikes, to the extent we will see a lot of these imports getting more expensive, I think most of us have things to lose, speaking in an isolated sense.
So I would say, if I actually take a step back and a medium-term view, right? On an average, the rupee depreciates by 2 to 3% over a long-term basis. In fact, our analysis shows that on a 3-year basis, the average move in the currency is at least 9 to 10%, which is aligned with fundamentals, US-India interest rate / inflation differential. We have seen this fructify over the last 1 or 2 decades consistently. But despite the sharp down move in the currency, that has not led to merchandise exports benefiting significantly. They've still moved in a range of $300 to $400 billion on an annual basis. So I would say exporters, yes, fundamentally they may benefit, be it pharma, specialty chemicals, textiles, but more importantly, IT services exports, where the turnaround story has been more significant. I would say tripling happening since the COVID period in software services and GCC related business service exports. That may benefit the most from rupee hitting the $100 mark. But what is more important is we keep talking about currency depreciation driving attractive value for exports and supporting export demand. But what about the driver of that currency depreciation is overall disruption in the global economy led by higher oil prices. So the demand for exports, the fundamental demand for exports may still be adversely affected if we are visualizing scenario of prolonged rise in oil prices above the $100 per barrel mark, dollar index prolonged basis above 100 levels, and then rupee also touching that psychological threshold.
So here's the thing. The rupee breached record lows repeatedly, which prompted the RBI to come up with a host of measures along with their spot market interventions. But how much more can the RBI intervene? Going by the RBI's management of volatility, how should the investors really read this fall? Is it a sign of economic stress, or is it a natural outcome of India's growth story?
I don't think it's a sign of stress. It is a sign of a few circumstances that have come together. So, for example, you've had that whole AI related theme that has grabbed the attention of global investors, which has benefited markets such as China and the US and few Asian economies, which have heavily invested in the AI technology development. So they have benefited. The other part is the war. So any economy which is a net crude oil importer such as India, again, that will be, will see a sort of a negative impact whenever there's a spike in crude oil prices. So it's not, I would not say it is something which is very India specific. It is a combination of factors. For example, the AI theme, the West Asia crisis, the fact that our equity markets before the West Asia crisis was seen as overvalued. So foreign investors felt that they get better returns, maybe less in the US. The US bond yield, which is a risk-free return, is giving you around 4%. The 10-year bond yield is giving you around 4%, which is a risk-free return. So it's a sign of a combination of factors which have come together, but it's not just an India-specific situation. But now the things have changed. For example, FY27, Indian equity markets are no longer seen as that overvalued. So whenever you will see an ease of the West Asia crisis, whenever crude falls, you will see some recovery in FPI inflows. FDI, India has not actually struggled. The struggle has been more because whatever FDI inflows we got, we lost that in profit booking, as well as the fact that Indian companies are themselves investing abroad. So that profit booking pit, that should reduce whenever global financial conditions become less tight. Right now, that the whole pickup in global bond yields, if you see the US, Japan, that is also another key determinant, because when the cost of money becomes more abroad, the ability of it to come into emerging markets reduces because the interest rate differentials have really narrowed. So it's a combination of factors.
The way we think about India's rupees problem or the balance of payment problem is that it's not a homegrown problem, in the sense that it does not emanate from domestic imbalances that have pre-existed or domestic excesses. In fact, we were doing relatively fine in terms of our macro growth, inflation, current account, so on and so forth, especially till the oil price shock hit us. So I think it's really the global financial conditions that have become very tight and dried up capital flows to emerging markets, including India. The fact that global growth is really tugging along on a single leg of the technology sector, of which India is not a big part, all of that has culminated into a balance of payment crisis. In fact, it's a rare occurrence that India is experiencing perhaps the third consecutive year of a balance of payment deficit, and this year it could be the north of $50 billion US.
See, frankly speaking, yes, as an economy, we have been very resilient, and that has led to a spike in our dollar demand on an annual basis. Because rupee is a price, it's a combination of dollar demand and dollar supply. And a resilient economy, a growing economy, does have a strong dollar demand that we have seen materialize into higher oil demand and, more importantly, higher gold demand as well. But on the other hand, I would want to still take a step back, take a balanced perspective in a world which has been led by shocks consistently post-COVID, from COVID to Russia-Ukraine war to Trump joining office and tariff-related issues, and now it's about the US-Iran conflict. So I would say in a world led by consistent geopolitical shocks, volatility in capital flows has affected our dollar supply more than our dollar demand, and that's adversely hitting the rupee. So till such time global risk aversion, adverse global investor sentiment does not shift, we may continue to see impact on the currency. Though yes, supportive measures by RBI, government, and consistent verbal intervention will definitely help the currency.
It's actually both, right? Rupee has been a little volatile even before this energy crisis happened. We were not on the favorable side of the trade deal as well. India was penalized by the US. that was impacting the currency for the longest period. There was also the story of higher valuation of Indian equities versus emerging peers, which did not favor India in 2024-25 as well. Then the AI trade, which was missing for India, and now the energy crisis. So we've been, hammered by a lot of these externalities in the last 1.5 years or so. So to some extent, it is, it's a reflection of the losing so-called growth shine or growth differential with emerging markets. And also, of course, policymakers will do their job, right? They will have to ensure that the currency is somewhere in this fair value and doesn't get impacted by the speculative positioning. And that is what they're trying to control to a large extent, where speculative positioning are so high that they're actually almost 2x of the natural, currency pain that we probably would be wearing because of the BOP crisis or BOP deficit that we have in the economy as of now. So I think policymakers are doing their bit to ensure that, the currency should not get caught by the speculative trade.
Right now, the rupee is the most undervalued in real effective exchange rate terms. What's that? REER is the average of a country's currency relative to a basket of major foreign currencies. The REER for April is at 90, the lowest since 2014. The rupee depreciated 11% in FY26 and has already depreciated 3% in FY27 so far. So things are bleak, but the economists are confident that the RBI will not let the rupee breach 100. Central Bank Governor Sanjay Malhotra also said that they would do whatever is required to ensure orderly price discovery. But the question in everyone's mind still is, where will the rupee end in this financial year? We'll keep you posted on that. That's it for today. You were listening to this episode on The Morning Brief. It was produced by Vinay Joshi and Rajas Nayak. Sound designed by Indranil Bhattacharjee. Keep listening to The Morning Brief wherever you get your podcasts. Stay tuned.